Hi everyone, I'm Isabella, and today I will be discussing mutual funds, an easy way to diversify, along with my team of Nyla, Richard, Eddie, and Vivek. We will be covering the pros and cons to mutual funds, differentiation among other investments, including ETFs and investment trusts, calculation of mutual fund returns, mutual fund classifications, and the mutual fund selection process. To start, I will be covering the basics of mutual funds and their advantages and disadvantages. A mutual fund is basically a fund that holds securities such as stocks and bonds by pulling together investor capital. Professional managers then tend this investment, working to make it grow and providing several benefits to investors with low capital requirements. Some key advantages of investing in mutual funds include diversification. Mutual funds are an inexpensive way to diversify, especially for investors with lower amounts of capital. You're able to purchase a small fraction of the mutual fund's already diversified holdings. Additionally, mutual fund investors get access to professional management. The managers who control millions or even billions of dollars in assets have access to all the best research from several brokerage houses, allowing them to value investments, especially alternative investments, more efficiently. Additionally, another benefit would be minimal transaction costs. Since mutual funds trade in such large quantities, they pay far less in terms of commissions, which can lead to overall higher returns. Another benefit of mutual funds is liquidity. Mutual funds are easy to buy or sell, with orders being able to be placed on the phone or online, and they can give you quick access to capital. Additionally, another benefit would be flexibility, since there are over 8,000 different mutual funds to choose from with differing characteristics, so investors are able to find one that fits their personal needs. Another key advantage of mutual funds is the services they provide, including bookkeeping services, checking accounts, automatic systems to add to or withdraw from your account, and the ability to buy or sell, as well as the ability to reinvest dividends, interest, or capital gains. Additionally, one last benefit would be the avoidance of bad brokers, which can come with bad advice, high sales commissions, and overall churning. However, there are also some disadvantages to investing in mutual funds. The first one being lower than market performance. About 80% of large cap mutual fund managers lagged the S&P 500 in the last 5 years, so it can be hard to find effective fund managers. Additionally, there are also some cost disadvantages, including having sales fees or load at 8.5% and expense ratios at 3% for some mutual funds, thus making it hard to justify those underperformances. Additionally, there are also some risks since many funds have become specialized or segmented in terms of sector and geography exposures, so their returns can have some unsystematic risk. Another disadvantage of mutual funds is that you can't diversify them in a market crash, as all equities will drop together. Lastly, one key disadvantage would be taxes. Mutual funds trade relatively frequently, and when they sell a security, you have to pay capital gains taxes that cannot be deferred. I would also like to highlight some mutual fundamentals. As the value of the securities in the mutual fund increases, so does the value of each share, and these mutual funds are able to pay dividends and interest to shareholders, as well as capital gains distributions of the fund when the fund sells a security at higher than what they originally paid. Additionally, the fund is set up as a corporation and is run by a management company such as Fidelity or Vanguard, and shareholders also are able to elect a board of directors. Lastly, each fund hires an investment advisor to oversee the fund's performance, who is generally paid a percentage of the total value of the fund on an annual basis.
So I'll be walking you through the major types of investment vehicles available in the market. We'll cover mutual funds, ETFs, and several specialized investment trusts, helping you understand their key differences and potential roles in your investment strategy. Let's start with open-end mutual funds, which dominate the investment company landscape, representing over 95% of all investment company assets. These funds have three key characteristics. They can issue unlimited shares. Shares are bought directly from and sold back to the fund. Pricing is based on net asset value, which is calculated by taking the total market value of securities, subtracting liabilities, and dividing by outstanding shares. In contrast, closed-end mutual funds operate quite differently. They have a fixed number of shares that can't be increased after inception. They trade like stocks on exchanges. Prices are determined by market supply and demand. This structure can create opportunities but also adds market risk. So ETFs have become increasingly popular due to several advantages. They offer greater tax efficiency because most trading occurs between shareholders. They can be traded throughout market hours. They typically have lower cost than traditional mutual funds. They provide focused sector and industry exposure, and the average expense ratio for ETFs is just 0.18%, significantly lower than the 0.5% for typical mutual funds. Now let's compare mutual funds and ETFs across 4 key dimensions. First, trading mechanics. Mutual funds price once daily after market close, while ETFs trade continuously throughout the day like stocks. This gives ETFs more flexibility for timing trades. Looking at market size, mutual funds hold 26 trillion in US registered assets compared to ETFs 4.4 trillion as of 2020. On costs, mutual funds can be commission free if bought directly, but may charge up to 8.5% through brokers, with a 0.5% annual expense ratio. ETFs typically have lower cost, averaging just 0.18% in annual expenses. Finally, transparency. ETFs provide daily holdings updates on their websites, while mutual funds only report monthly or quarterly. These differences make each vehicle suitable for different investment strategies and goals. Now let's briefly touch on unit investment trusts. Unit investment trusts are fixed pools of securities, typically municipal bonds. They're unmanaged and dissolved at maturity. Minimum investment is usually around $1,000. Sales commissions range from 2.9 to 4.9%, and they are best for long-term investors. Now let's explore real estate investment trusts, or REITs, which offer a unique way to invest in real estate without directly owning property. REITs come in 3 distinct types: equity REITs, where you own and manage physical properties; mortgage REITs, invest in real estate debt; and hybrid REITs, which combine both equity REIT and mortgage REIT approaches. Key features include they must distribute 95% of income as dividends to shareholders. At least 75% of income must come from real estate. Shares trade on major exchanges, offering better liquidity than direct real estate. And their track record shows significant volatility. For example, the Morgan Stanley Rate Index fell over 2/3 between 2007 to 2009, but doubled in value from 2011 to 2021. REITs offer portfolio diversification benefits since they do not closely correlate with the broader stock market. But remember, real estate markets can be highly volatile. Now let's discuss hedge funds. They are sophisticated investment vehicles that, despite their exclusive nature, often come with significant risks and concerns. They are largely unregulated investment pools with significant risks. They have a high fee structure, typically 2 and 20% of assets under management, 20% of profits, limited transparency and liquidity, poor historical performance compared to traditional investments, restricted to accredited investors with $1 million net worth, excluding primary residence, or $200,000 annual income, $300,000 if married. Despite their elite reputation, hedge funds' high fees, risk, and underperformance make them an investment vehicle most should avoid. Now let's discuss our key takeaways. Open-end mutual funds offer stability and professional management. Closed-end funds provide market trading flexibility. ETFs combine low cost with tax efficiency. Specialized trusts offer access to specific market segments. Hedge funds, despite their allure, often present more risk than rewards. The key is matching the investment vehicle to your specific goals, time horizon, and risk tolerance. Consider factors like cost, tax efficiency, transparency, and liquidity when making your choice.
In 14.3, we're going to be learning about how to calculate mutual fund returns and their expenses. One of the first things to know is the distinction between load funds and no load funds. A load is basically a sales commission added to the purchase of a mutual fund. Load funds are usually sold through brokers or financial advisors who charge commissions. These can range between 3.75% to roughly 6%, but sometimes as high as even 8.5%. When buying funds, you'll typically choose from share classes A, B, and C. Class A shares have front-end loads, meaning you'll pay a fee when you purchase the fund. Class B shares skip the upfront fee but charge a back-end load that decreases annually. A back-end load is essentially a percentage fee on your shares when you sell them. Class C shares have fees both at the front end and the back end, which means they're the ones with the highest annual costs. Now, on to no-load funds. No-load funds don't charge a commission. You buy them directly from the fund company, avoiding fee and sales fees altogether. Firms like Vanguard and Fidelity are heavily known for their no-load mutual funds. Now, from this slide, it's important to remember that all the different classes of shares are from the same portfolio, but just different fees. So if you want to save money, you aim for no-load funds to maximize your investments and minimize your costs. Mutual funds can rack up significant expenses to cover advisors, custodians, transfer agents, and underwriters, plus operating costs like legal fees and commissions on trades. When you're choosing a mutual fund, always check its expense ratio. The expense ratio is a key metric comparing the fund's expenses to its total assets. Typically, this ratio falls between 0.05% and 2%, but it can even go as high as 4%. It's crucial to pick a fund with low expense ratio because mutual funds don't pay their own costs. You do. Mutual funds pass these expenses to investors by selling some of the fund's securities, lowering its net asset value or NAV. A significant part of these costs comes from trading activity, which ties directly to the turnover ratio. A high turnover ratio means more trading and therefore higher expenses. Plus, trading can lead to increased short and long-term capital gains taxes, which eats into your returns. So when choosing a mutual fund, look for a low expense ratio and be cautious of high turnover to protect your investment and maximize your returns. Many mutual funds want to make a name for themselves in the market, so they spend on advertising and promotions. These costs are passed on to investors and are known as 12b-1 fees. These fees can be as high as 1% annually, and unfortunately they don't benefit the shareholders directly. Essentially, you're paying a portion of your investment each year to cover the fund's marketing expenses. Now let's look at an example. If a fund earns 10% but charges a 1% 12b-1 fee, you actually earn 9%. On a $10,000 investment over 20 years, earning 10% would give you around $67,275. But with a 1% fee reducing your earnings to 9%, you'd only have about $56,044. That fee just costs you $11,231 over time. So in this slide, remember that it's essential to be aware of the fees and to understand their long-term impact on your investments. So in this slide, we see a chart that pretty much summarizes all of the expenses and fees that you'll probably see when investing in a mutual fund. So you have the different types of fees in load funds with the class A, B, and C shares. You have the management fees, the expense ratio, and the 12b-1 fees. In this slide, we're going to learn how to calculate the returns of mutual funds, which can come from the distribution of dividends, capital gains, and changes in the net asset value or NAV of the shares you hold. Therefore, when calculating the total return from a mutual fund, you'll need to consider all three of these factors. Let's assume we have a mutual fund with a beginning NAV of $19.45, an ending NAV of $23.59, 60 cents of dividends distributed, and 47 cents of capital gains. To calculate the total return, we're going to add the sum of capital gains and dividends to the difference between the ending NAV and the beginning NAV. With that value of $5.21, we're then going to divide by the beginning NAV, which should give us a total return of 26.79%. That is the total return of the mutual fund that we have here in the example.
Hey, I'm Richard, and I'm going to be talking about different types of mutual funds and their objectives. Money market funds invest in short-term, high-quality investments like treasury bills, certificates of deposits or CDs, and other securities with maturities of less than 30 days. Some of their key features include low risk due to their short-term maturities. They also provide accessibility for smaller investors, as well as liquidity for investors who may need their capital to be readily available. They have low expense ratios as well. So some special types are tax-exempt funds that invest in municipal bonds, as well as government securities funds. An example of a money market fund is the Vanguard Federal Money Market Fund. which invest in short-term U.S. government securities. Stock mutual funds invest primarily in stocks, aiming to achieve growth over time through capital appreciation with a focus on diversification. There are many types of stock mutual funds catering to different investor preferences. For example, someone who values sustainability might choose an ESG fund. As you can see in the pie chart, stocks, also known as equities, make up the majority of mutual fund assets. A hybrid between a mutual fund and an individually traded stock or bond would be an exchange traded fund or an ETF, and the most popular one would be the SPDR S&P 500 ETF, and they seek to provide investment results that mirrors the price and yield performance of the S&P 500 index before expenses. So if you look at the top left, you can see the net asset value as of October 23rd and the expense ratio of the fund. The table in the top right, you can see the holdings of the fund compared to the holdings of the index. You can see they pretty much mirror. And in the bottom table, you can see that the performance of the fund and the index are not exactly one-to-one. This is due to tax implications as well as expense ratio. Balanced mutual funds invest in a mix of stocks, bonds, and sometimes preferred stock to balance risk and return. They aim to have moderate risk and steady income with a portfolio composition that varies based on desired risk levels. So as you can see, there are several types of balanced funds. A specific example would be the Vanguard Balanced Index Fund, which holds a mix of stocks and bonds, maintaining about a 60 to 40 stock to bond ratio. In the chart on the right, you can see the evolution of household ownership of mutual funds. And as of 2024, over 50% of households own mutual funds. Now I'm going to talk about the difference between asset allocation and target retirement funds. So asset allocation funds hold a dynamic mix of stocks, bonds, and money market instruments. The allocation is adjusted based on economic outlook, aiming to outperform the market. Unfortunately, the track record for market timers is less than impressive, so think carefully before investing in such a fund. An example would be the T. Rowe Price Balance Fund, which has a 65 to 35 equity to fixed income ratio, but that varies based on market conditions. Then you have target retirement or target date funds that are set up with a specific retirement year in mind. This is ideal for hands-off investors who want a strategy that adjusts with their life stage. So here I have an example of a target date fund, which is the Fidelity Flex Freedom Blend 2065 fund. In the bottom left, you can see this fund is for people aiming to retire from 2065 onwards, and the expense ratio is pretty minimal. In the top right, you can see the performance of the fund, and in the bottom right, you can see the allocation of the fund, where 50% is in equities, US equities, about 42% in non-US equities, and 7% in bonds. I would have less in bonds, but that's just me. Bond funds focus on providing income as opposed to capital appreciation. They offer low volatility and steady income. Some common types are government, corporate, and municipal bond funds, which are then further categorized by maturity. One example is the PIMCO Total Return Fund, which seeks to maximize total return through higher quality intermediate term bonds. Mutual funds provide convenient services like automatic investment and withdrawal plans, allowing for regular contributions or payouts. They offer automatic reinvestment of dividends, easy fund transfers online or by phone, and even check writing options. Plus, they simplify tax reporting, making it easier to manage your investments.
Now that you know more about mutual funds, you may be well wondering how you can go out and buy one for yourself. Here we will end our presentation by discussing how to select a mutual fund that is right for you. The process of buying a mutual fund involves determining your investment goals, identifying which funds meet your objectives, and then evaluating those funds. The first step in buying a mutual fund involves determining exactly what your investment goals and time horizon are. In order to invest, you need to have a clear answer as to why you are actually investing. In order to do this, there are many different questions that you can ask yourself. For example, is it to provide additional income to supplement your retirement income? Or is it to save for your children's education? Or for your own retirement 30 years from now? You can also ask yourself, do you want your investments to be tax deferred? Also, how much risk are you comfortable with? Once you are able to answer these questions, then you have determined your goals and are ready to go out and find a fund. As we saw earlier, there are quite a few different classifications of mutual funds. You can have money market, stock, balanced, asset allocated, life cycle, and bond funds. And within each of these classifications, there can be quite a few different subtypes. For example, there are subclassifications under stock mutual funds, such as growth, sector, and index funds, among others. Your investment objectives will lead you to which classification is right for you. Some ways to learn and identify a fund's objectives are to look on one of the mutual fund screening websites. Each website listed here has its own benefits and advantages. For example, the Wall Street Journal Mutual Fund and ETF Screeners lets you begin by picking a broad category and then moving into an expanded list of criteria and categories. On the other hand, the Morningstar Fund provides fund analysis and classifies funds based on objective and management style. Also, one of the advantages of the Yahoo Finance Mutual Fund Screener is that it's free and also lets you begin with a broad category similar to the Wall Street Journal one. Now, once you've found some funds with objectives that match your own, it's time to evaluate them. Evaluation means looking closely at past performance and scrutinizing the costs associated with each of these funds. Although past performance doesn't necessarily predict future results, research has shown that mutual funds that have done poorly in the past tend to do poorly in the future, and there is some slight evidence that good performance may carry into the future. Be able to answer important questions about your fund before selecting it, such as how has the fund performed over time, and what securities does the fund hold. These are just a few questions that you can ask once you've made sure that the fund meets your objectives before officially selecting it. Additionally, as you see here, you may be thinking to yourself, I have a hard time finding out more about stocks. How am I supposed to find out this information about a mutual fund? Well, one of the first things that you can do is look through a prospectus or the Wall Street Journal and websites like we mentioned before, and any website online. As we see here on this slide, this shows how a typical fund listing generally appears on one of the websites that we've mentioned. So, as you can see here, it'll say different key information about the mutual fund that you're interested in investing in, and this slide also provides some important definitions of the terminology used when deciding which mutual fund is best for you. Finally, actually making the purchase. Now that you know exactly what fund you want, it's time to do some buying. Here you have two choices. You can either deal directly with the investment company that runs the fund, or you can purchase the fund through a mutual fund supermarket. The easiest way to buy a mutual fund is to pick up the phone or go on the internet. Vanguard and Fidelity are two of the largest mutual fund families, and both have toll-free telephone numbers and websites that you can use to set up your account, move money in and out of your funds, switch funds, and to get educational material on the different funds that you're interested in. The downside of buying directly from different mutual funds is that if you have money in 8 different mutual fund families, you'll have 8 different statements to deal with. In that case, it might be more beneficial to buy through a mutual fund supermarket. Fidelity or Charles Schwab are 2 examples of mutual fund supermarkets that allow you to pick mutual funds from different families, but still be invested in all of them with the same statement. When you invest through a mutual fund supermarket rather than buying direct, you may have a small transaction fee, which is something to consider when you're officially making your purchase. Thank you so much for listening to our presentation on mutual funds. Here are some of the resources we used. Thank you for your time.